Millions of people do trading, whether it is in equity futures or options. But why is it that the failure rate is extremely high? And do not go by the picture depicted on social media of unverified accounts, where influencers post exponential gains, thereby depicting the market as a slot machine, waiting for you to come and press the handle and start minting money. Reality is far away from such mirage. But what is the reason behind such high rate of failure in the markets, even though there are thousands of strategies, indicators in the market to assist a trader? And then the questions arises as to whether such strategies, indicators are of any use and serve any useful purpose to understand the markets and its movements. There cannot be a panacea, one universal answer to that. But there is one core aspect of trading that can be said to be the bedrock on which a trader should execute all his trades, but is rarely done, except for a few who have identified that aspect, worked on it, and imbibed it in their trading plans. That is the psychological, the mental aspect of trading. All the decisions which a trader takes in market, whether it is prompt or delayed, whether it is buy or sell, all of it comes from his mind, which is always affected by the inherent emotions running through the trader at that point of time. And the outcome of trade is much more dependent upon the emotional aspect rather than his strategy. By this, one cannot say that strategy loses its importance or does not play any role in trading. Surely it does. But as markets are composed of individuals and organizations, therefore there is no single strategy which will work for every individual, whereas there can be many different strategies that may work in the market. Every trader, being an individual, has his own personality, different way of thinking, different reactions to different situations based on his perceptions, and can form his own strategy according to his biases or thinking. And that may work for him in the markets, but may not for others, as the other person will have different outlook towards the market based on his biases and outlook. One thing which every trader lunges for and does is to look for one golden strategy that works in the market every time he punches a trade, regardless of market conditions, completely ignoring the most important aspect, that is himself, his frame of mind. The core reason behind it is the deep-rooted instinct of instant gratification, hardwired in us genetically since the ancient times when the human species lived in caves. As a caveman, humans were hardwired to fill their stomach instantly with whatever they could forage or kill, which resulted in the instinct of instant gratification being hardwired into the human species, which in fact enabled it to survive and multiply. Apart from the deep-rooted instinct of instant gratification, we, the human species, have a range of core emotions which were essentially required during the evolutionary process to safeguard against the dangers present in the environment and for our growth. But as we started living in constructed societies, these inherent core emotions and instincts became redundant due to the food and social security provided in such societies. But when a trader enters the market and is looking for punching a trade or is into a trade, these inherent core emotions are unconsciously triggered and come to the fore instinctively, overpowering the balanced decision-making aspect of trading, resulting in either holding on to a losing trade, punching in a trade too early, seeing the ticks on the chart, cutting short a winning trade, taking multiple trades without confirmation of your setup strategy, trying to recover a loss incurred in previous trade. All these core emotions are imbibed in each of us, and every trader has experienced it repeatedly in his trading journey, though they are not easily identifiable in the usual course of trading, as the trader is completely occupied with, concerned with the outcome of trade rather than the core reasons behind it. Every trader who has traded long enough in the markets, has spent time on the charts, can easily relate to these core emotions when they are referred to by their common names. The psychological aspect of trading holds immense importance for a trader if he wishes to get some success in his trading journey. And this psychology reflects itself in various emotions inherent in a trader due to his human aspect. Every error, mistake that a trader commits in a live market can be retraced back to the core emotions of human psychology, as when a trader holds on to a losing trade, the trader has fallen prey to the emotion of hope. Similarly, when a trader is punching in a trade too early, expecting the market to go on his gut, feeling the trader has fallen prey to the emotion of hope. When a trader is punching in a trade too early or taking too many trades, seeing the ticks on the chart going up and down, the trader has fallen prey to the emotion of FOMO, fear of missing out. When in a trade which is running on positive side, the trader intentionally cuts short the winning trade, having a false sense, belief that market may reverse on him and shall take all of his unbooked profit, the trader has fallen prey to the emotion of fear. Or when the trader, trying to recover a loss incurred in previous, punches in trades on his whims, the trader has fallen prey to the emotion of revenge. In turmoil of all these emotions, the trader loses his focus from the market as to what the market is reflecting on the charts. The trader is disbalanced and falls out of flow. And flow is what all matters as a trader, when everything is in sync and trades are not governed by emotions, but are taken objectively by the trader, by truly reacting to the price movement, the bars on the chart, rather than trying to predict where the market is going to go. A trader executing his trades according to his plans without falling into the emotional cycle, then in the short run, it does not matter whether the result comes positive or negative. As remember, trading is not a sprint, rather is a marathon where a trader has to execute his plan repeatedly, wherein the emotions play an important role in decision making. One way of not letting your emotions run the trade is to form a set of trading rules as to the trigger point where you enter in a trade and defining your exit point in both scenarios. If trade runs in your side, the target price, and if trade runs against your position, then your stop loss. The key is to sticking to the set of trading rules and not letting each tick on the chart affect your decision. Thereby you can control the trigger to the emotions of FOMO, fear, hope, revenge trading. And don't think you can entirely eliminate these emotions. Know, as these emotions are inherent, you can only control the triggers. Recognizing and acknowledging these emotions is the first step. Persistently working to control their triggers is the subsequent step. It takes time to alter your ways and work on psychological aspect of trading. As they say, Rome was not built in a day.